Hello, and welcome to the latest Insights Live Tax and Trust Strategies for Your Estate Plan, the second of our three-part series this month on estate planning. I'm David Peterson, Head of Advanced Wealth Solutions here at Fidelity. Thank you for joining us and for submitting questions to help form our discussion. Today, I'm joined by Pamela Perrone Benson, an advanced planner based in New Jersey, and Jacqueline Calandriello, a wealth planner based in New York City. Welcome to both of you. It's great to see you again. Now, before we get going, I do need to let you know that Fidelity does not give tax or legal advice, and nothing we discuss today should be interpreted as tax or legal advice. The information we're providing is going to be general in nature, and it may not apply to your unique situation. If you do have legal or tax questions about your specific situation, we encourage you to talk to your attorney or tax professional. Now, as I mentioned at the top, this is the second of our series on estate planning. Last week, we covered the documents and people you need to form your plan, including selecting an executor or trustee, considerations around when and how much to gift, and what heirs can expect from the estate settlement process. If you missed our first episode or want to see it again, you can view the replay at fidelity.com/insights live. Today, we're going to start by focusing on taxes and then move to an in-depth discussion of the various trust structures you might want to consider later in the show. So let's go ahead and dig into it. Pamela, let's start with a little grounding before we dive into trusts and taxes. What are the concerns that hold people back from planning for wealth transfer?
Yeah, great to be here, David. Thank you. And generally speaking, I think most people want to make it easier for themselves and their family, but they don't want to think about death, right? That's not a pleasant topic, nor do they want to discuss it with others. And not only death, but transferring assets during life, it brings to the surface the reality that they're going to pass, and it presents questions as to whether or not you want to see somebody enjoy it. I say with the warm hand as opposed to the cold hand. It's really facing your eventual mortality, not to be so blunt, and staring your legacy head on. I think the second reason, while many people want to make the things easier, they want to reduce taxes if possible. Many worry, though, about giving up control and possibly running out of money to care for themselves. So many factors can affect a financial plan, a large one being the long-term care in the future. No one ever wants to be a burden on someone else, so it becomes a balancing act as to how much do you keep versus how much do you give away to save those taxes.
Yeah, and Pamela, I would just add that I think you brought up a great point when you think about long-term care or even just healthcare uncertainty in general. When I'm working with my clients, that's often a big concern. Unfortunately, most of us aren't getting healthier as we get older. And when we think about that, wanting to give gifts to our family or to our friends, and to see that and see the joy of how that helps our family during our lives, we need to kind of couple that with thinking about, well, what if we were to experience an unexpected health event? And would I potentially need those assets? And that's where I think it's just so important to try to proactively plan. And I mentioned last week how when I'm working with my clients, I will run Monte Carlo simulations, and we will incorporate those potential healthcare costs to try to understand what the impact is to their plan, so that my clients can then make a more informed decision that's best for them and their family, and just help provide them with overall peace of mind.
Yeah, that's a great point. You don't want to be giving money away that you're ultimately going to need to live your best and happiest life. So let's get right into what gifting assets means from a tax perspective. Jackie, when people inherit different types of assets, what are the potential tax implications?
Yeah, so David, it will actually depend on the type of asset. So we have assets that are going to be subject to what's referred to as a step up and sometimes potentially a step down. And the step up it's going to refer to a tax provision that's allowing the value of an inherited asset to be adjusted to the fair market value at the time of the original owner's death. And this is going to eliminate the capital gains taxes for the beneficiary on the value of any appreciation that occurred during the owner's life. And if you think about those assets that might be subject to a step up, it would be real estate. Think about your stocks, bonds, mutual funds, or exchange traded funds that you might hold in a taxable investment account. Your collectibles, arts and furnishings, privately held businesses, as well as assets held in a revocable living trust. And if to think of an example, I'll use real estate. So if you paid $500,000 for a home and you lived in it for several years and passed away, and the value on your date of death was $2 million, that now becomes the cost basis that your heirs would inherit. And they would only have to pay income taxes if the value had appreciated above that $2 million cost basis that they inherited when they sell that property. Now, there's also assets that are going to be ineligible for a step up. And that's going to be our retirement plans that we might have through work. So 401ks, 403bs, 457 plans. Also, if you have any individual retirement accounts, such as a traditional IRA, SEP IRA, rollover IRA, or Roth IRA, annuities, even if funded with post-tax dollars, cash CDs, money market accounts, pensions, as well as assets in certain types of irrevocable trusts.
Great. And so you mentioned retirement accounts. These are often a significant part of someone's overall portfolio. There are very specific rules which can get pretty complicated pretty fast. So let's start with passing assets in such accounts to a spouse.
Yes, so spouses will have 4 options with respect to inheriting retirement accounts. A spouse can roll over the assets into their own IRA and treat them as if they're their own account. And if you think about who that might work well for, it's somebody who might not have an immediate need to use these assets, and potentially you're younger than your spouse, and you want to try to delay taking required minimum distributions on those funds. The second option is you can transfer the assets to an inherited IRA. And this can be a good option if you're under the age of 59 and a half, and you might need to access these assets now or before you attain age 59 and a half. And the reason is if you transfer those assets into your own IRA and you take a withdrawal prior to that age, you may be assessed a 10% penalty, whereas that 10% penalty would not apply if you're withdrawing from an inherited IRA. And then the third option is you can roll over the assets into a new or existing IRA and complete a Roth conversion. And this is really going to be a decision that you would make when you look at the holistic picture and your tax situation and your goals and objectives. But this is an option that a spouse would have, whereas a non-spouse beneficiary would not have this option. And then the fourth option is you can disclaim all or part of the assets. And if you choose to disclaim the IRA assets, the assets are going to pass to the remaining primary beneficiary if you are not the sole primary beneficiary, or to any contingent beneficiaries named by your spouse. And you might think why somebody would potentially not want to take receipt of an inheritance. And this would be an option typically if you might not need the funds, and potentially if receipt of those funds could cause you to exceed the estate tax exemption amount, or maybe even increase your tax bracket.
Right. So it seems a little counterintuitive, but it could make sense in certain situations. Now, of course, not everyone has a spouse, or perhaps they're already the surviving spouse. So Pamela, what about a non-spouse beneficiary?
Sure. The current rules are that an inherited IRA must be distributed within the 10 years for deaths after January 1st, 2020. So unless you fall into an exception, it's going to be 10 years. And there's 5 exceptions to the rule. Jackie, you just mentioned one, the spouse. In addition, there are 4 others who can stretch over life expectancy, as they're considered what we call eligible designated beneficiaries. So who are they? Individuals that are not more than 10 years younger than the IRA owner, a minor child of an account owner, so minor child, not grandchild, and also somebody who's disabled or chronically ill. So there's the stretch for some, the 10-year rule for others, and then some IRAs are going to need to be distributed within 5 years. So as an example, certain trusts or estates are named as beneficiary, they may be subject to distribution over those 5 years. If you have a trust named as beneficiary, you really should have it reviewed with your attorney. You'll want to understand how the trust is structured and what will determine when it must be distributed and which beneficiaries are relevant when they're calculating those RMDs. So keep in mind, if you're subject to the 10-year rule, you may be required to take mandatory distributions over those 10 years. And by year 10, the entire account's going to need to be emptied. However, if you inherit, as Jackie had mentioned, the Roth, there's no mandatory distributions, but that too is subject to be distributed by year 10.
And Pamela, I would just add that for clients who might be subject to the 10-year rule, you also want to consider the withdrawal strategy in context of your broader plan. And just because you may have to take a distribution or a smaller distribution in years 1 to 9, or potentially not any distribution until year 10, it might actually make sense to take larger distributions in certain years if your income is expected to potentially be lower. Or if you're trying to actually even out the distributions, you're not hit with such a large tax bill all in one year.
Yeah, great points. And I like, Pamela, your point about if you're going to leave, if you're going to name a trust as a beneficiary, you better have your attorney look at that document to make sure that it's written in a way to take advantage of the laws the way they're written. So real estate also has some special consideration. It also is an asset that forms a large percentage of most clients' overall portfolio, but probably less from a taxation standpoint and more from a complexity standpoint. So, Pamela, what do you tell clients to consider about passing on their real estate?
Yeah, and less from a tax, I agree, and sometimes emotional, but given the complexities, the appropriate approach to passing down a house, it's just not clear cut, right? There's not one answer. There's many options. Maybe you want to including jointly owning the property with rights of survivorship. Maybe you're selling it to somebody who wants it during their life. Maybe you're making a specific bequest to somebody via will or trust. Of course, there's the emotional aspect, as I mentioned, of passing down a house. You may want to keep a house in the family because of the memories that have been made there. You may decide to leave the house to multiple peoples in a trust. You need to think about that for sure. It can be very tricky when you're passing down a vacation home, for example. That's the one that I'm often questioned. You may think it is a great idea. Leave a home to multiple people to continue the memories. They can enjoy it. But there's a lot of things you have to consider, right? First, are the heirs really interested in the property? Do they want it? Do they have the same emotional attachment? Also, maybe thinking about maybe you have multiple children and one uses the home all summer and the other one comes once a year, right? What does that present? The house could also become more of a burden than a help, right? You also have to consider who's paying the maintenance, who's paying the taxes, right? What if the roof caves in? So you could see, David, there are some problems there. Once had a family recently share July 4th was a contention every year. The family enjoyed it, but one sibling wanted to use it over the other, and every year they would fight over who got it for July 4th. So well-intentioned, it just didn't play out that way.
Yeah, that makes sense. So there's a lot of non-financial considerations around real estate. You mentioned some common options for passing on a home as well as tax considerations. Can we go into a little bit more detail around that?
Sure, and it depends on how the house is titled. If the home is in an individual name, most often it's going to pass through probate as per the terms of last will and testament. Some states you can own a property joint with rights of survivorship. In that case, the home would pass to the other respective owner. There's an option called tenant in common, which allows one or more owners to have an undivided interest in the property, gives them full access and use. However, when the one owner dies, their share of the property transfers to the estate to be distributed in accordance with their will. Some states have the transfer on death or beneficiary option. It's not offered everywhere. Some states call that transfer on death beneficiary option a ladybird deed. It's a type of deed that lets you name someone to inherit your real estate automatically when you die without going through probate, while you keep full control during your life. So kind of like naming a beneficiary. That's a great option in some states. A revocable trust, that's going to spell out, I know we're going to get into trust, but a revocable trust, it's going to spell out exactly and how when those assets are going to pass, but the grantor stays control of the assets during their life. Some other things to think about, right? If you're trying to remove, we mentioned estate taxes. If you're trying to remove assets from your estate, you might want to consider some types of irrevocable trusts. One strategy is called a QPRT. Here we go with the acronyms, a qualified personal residence trust. That home is transferred to a trust right away, but it allows the original owner to retain the right to live in the home for the duration of that time. And the trust has an end date, after which the ownership of the house is then going to be transferred to the beneficiary. A QPRT's estate tax benefits increase as the interest rates rise, but if the original owner dies before the trust terminates, the value of the home is actually included as part of your taxable estate. I kind of say you're like betting against yourself, right? You hope you live the term of that trust. It's also important to note that the trust cost basis does not get stepped up in that instance of the QPRT. And then another option I'm thinking about is families could also consider transferring ownership of a property into a limited liability company. And you'll see from an estate planning perspective, a tax perspective, gradually passing shares of that LLC onto heirs or into some type of trust. So that LLC structure is a good one. It can protect families against potential liability claims as well.
Yeah, I appreciate that you mentioned the Lady Bird deed because I know we get lots of questions on that. And clearly you can get more complicated with a QPERT, but obviously there's pros and cons, as you'll see as we go through all these different trust strategies, pros and cons to them, and you need to make sure that you balance those out right, in the right way. But let's continue talking about like tricky assets. So there's other things like tangible assets like art or collectibles. Jackie, what guidance do you give clients around these?
Yeah, so David, we'd consider them tricky just because how do you divide them? They're not assets that are going to be easily divided. And that's where, when I'm working with my clients, we want to focus on what do we want to occur with these assets, such as being sold. Is it something that's important for us to keep within our family? And when we think through this and whether we want to potentially sell or gift these assets during life, we also want to think about which heirs might be more attached to the actual assets rather than the monetary value if it was sold. And that's again where a family conversation is truly critical, as it'll provide an opportunity to share intentions, but to also hear from loved ones and allow them space to ask questions, give feedback, and potentially express concerns. And again, this is not going to mean that you need to change your plan or ensure that all parties are going to be happy with your decision. But it can help to eliminate questions and potential conflicts among your heirs when you do pass.
Yeah, it's a great point. So, my mom had a bunch of collection of collectibles. They didn't have a lot of monetary value, but they had sentimental value. And we were sort of doing it after the fact, and everyone kind of wanted the collection. And so the way that we solved that was by rolling dice, basically. And each sibling got a chance to roll the dice. Highest number got to choose which of the collection that they wanted, and we did that till we basically went through the whole collection. So that worked for our family, but there's lots of ways that you can think about that. Finally, let's talk about a newer type of asset, digital assets. Pamela, how do you plan around cryptocurrency and other types of digital assets? How do they fit into your estate plan? And are there any special tax rules around gifting or selling?
Yeah, and I was thinking, David, we can't roll dice for digital assets, right?
Yeah.
Or, years ago we used to talk about the frequent flyer miles. So now we have to think about digital assets, right? Many people own digital assets, everything from a domain name and electronically stored photos, right? Think about your phone and the photos and the videos, email, social media account. It's really important to understand the terms of use regarding your access and control of the data. Jackie, you mentioned a list. I would absolutely make a list of your digital assets, your passwords, so that people you trust know where to find them. That's the biggest problem with digital assets. A lot of times nobody knows they exist or what you have. Backup data could be stored in a cloud to a local computer or storage device. That's good to have. And to help protect your digital or online assets, work with an attorney. They're going to provide consent in your legal documents. So if you pass away, right, those photos are memories and somebody probably wants them. You also have to consider your crypto holdings, if any, and how they fit into your estate plan. Crypto is a bit unusual because it can be viewed as either tangible or intangible personal property, depending on how you own it and how it's stored. You're going to want to make sure, though, that your documents specifically address crypto for sure. And probably the most important consideration is that someone, again, knows the crypto actually exists. So a letter of instruction informing your fiduciary, your heirs, how they can access the cryptocurrency is important.
Great hints. Now, we've been weaving taxes into the discussion, but let's level set on the current federal rules. Pamela, who's subject to federal estate tax?
Yeah, so I say we pay income tax our whole life and then we pass away, right? There's a death tax. But their life and gift estate tax exclusions have now increased to $15 million per person. And that amount generally rises each year based on inflation. Of course, the law could change. Spouses may be able to combine their federal gift and estate tax exclusions, so allowing a married couple to transfer $30 million free from federal transfer estate tax when they die or during their lives. And that's often referred to as we call portability. I call it combinability.
Right. And what about state estate laws?
Be careful where you live. Some states have their own estate and gift tax laws. Some states have state estate tax. Some have inheritance tax. Some of them have both. It's important to understand what the rules are in the state you live in to really understand whether or not you may need to take additional steps to reduce that estate or inheritance tax. I was just thinking of some clients that I met with recently who said they were moving to another state for income tax purposes, and they had no idea that that state was one of those states on the map that had an aggressive estate tax. For example, take New York, right? New York has a state estate tax. And we just mentioned at the federal level, there's portability. New York doesn't have portability, right? So that means if one spouse dies, the exclusion dies with them. And there's different kinds of trusts that you can set up to preserve that exclusion. So super important to discuss with an attorney in those states with the state estate taxes.
It's tough to say. Okay, we're going to discuss some of those trust options shortly. But before we do, Jackie, can you remind us how the annual exclusion and the lifetime exemption work together?
Yes. So there's an amount that you can gift each year without a federal tax liability or reporting it to the IRS. And for 2026, that amount is $19,000. And if you go above this amount, you're required to file IRS Form 709 to track the amount of your gifts that are above that $19,000 annual exclusion. But that doesn't necessarily mean you're going to owe taxes. Instead, the amount that you gift above the $19,000 is going to reduce the amount of your lifetime exemption, which, as Pamela mentioned, is $15 million per person currently. And annual gifting is a great way to meet your intentions and potentially remove a large sum of assets from your estate without the need to even venture into more complex estate or trust planning. And if you think about a married couple, together they can gift $38,000 to as many people as they want. So if they have 3 children who are also married, they can gift $76,000 to each couple to total $228,000. And now let's add grandchildren. And if there's 6 grandchildren, they can also gift $38,000 to each grandchild to total $456,000 in non-taxable gifting. And then if we think about continuing this gifting annually, let's say 10 years, well, now you could have potentially reduced the value of your estate by $4.5 million through annual gifting solely. There are some key exclusions. So gifts to charities are not taxable, nor are gifts that you make to cover tuition or healthcare expenses for another person, as long as you make those payments directly to the service provider. Also, 529 savings plans, they do have unique rules that allow for larger gifts, namely the ability to front load 5 years of gifting in 1 year.
Jackie and David, I was thinking, we have clients that come to us and say, I have a taxable estate, right? What should I have been doing? And we say, well, the gifting kind of over the years would have been helpful. So definitely something to consider, because once that year turns, you don't get it back. It's annual.
Right. Totally. Now, earlier we were talking about step up in basis. Pamela, help us understand the potential impact of things like capital gains taxes as we're considering all these different strategies.
Yeah, so when making a gift, you absolutely have to consider the income and the capital gains tax consequences for the person who's receiving the gift, right? Not all gifts are treated equally, depending on what you gift. If you gift cash, generally there are no income tax consequences to the person who's receiving it. But there could be, as Jackie mentioned, gift and estate tax implications. But if you give appreciated securities, the capital gains can definitely be significant. So let's take another hypothetical. If I give $19,000 of cash to a grandchild, they keep the $19,000, they can choose how to use it. But however, if you gift $19,000 of a highly appreciated stock that you bought for $1,000, and now the recipient sells the stock with a gain, it becomes a taxable event, and that grandchild would owe capital gains and federal capital gains and possibly state capital gains as well.
Right. Okay. Thanks for clarifying that. So we mentioned a couple of specific types of trusts earlier, specifically the CUPR related to real estate. But let's step back a little bit and level set on trusts. Trusts are either revocable or irrevocable. Pamela, what's the difference?
Yeah, and I like to think of these trusts trust you set up now during your life, revocable, irrevocable. And then there's this category of testamentary trust, a trust that springs to life when you die. So let's start with revocable, right? It's considered a will substitute. It's often referred to as a living trust because it's created during your life. You're called the grantor. And it's a flexible arrangement. It can be changed or dissolved at any time. You control the assets during your life, and it's generally used as your social security number. As a result, the assets in a revocable trust are included in the grantor's estate for estate tax purposes, right? We talked last week, the main purpose a lot of times with the revocable trust is to avoid probate, right? Now that revocable trust can create an irrevocable trust when you die, so it could spring to life in that case. Now, an irrevocable trust, the name implies it, right? It's irrevocable, meaning it can't be revoked by the grantor, and it generally can't be amended during your life once it's executed. Now, the value of the assets transferred to an irrevocable trust during lifetime, it may be considered a taxable gift. As Jackie mentioned, you may have to file that 709. However, it's all about the appreciation on those assets could generally be excluded from the grantor's estate at the time of death, right? Simple example, I put $1 million into the irrevocable trust and it grows to 5 million when I die. We got the growth out of the estate, the appreciation. But when establishing an irrevocable trust, right, the grantor is giving up control of assets transferred to the trust, right? You can't have it back. You can't use it, generally speaking. And accordingly, it's important that a grantor only transfers assets to the irrevocable trust that they're comfortable doing so, right? David, both you and Jackie talked early on. You don't want to give away assets that you're going to need. You need to discuss the income. You also need to discuss the income tax implications of the irrevocable trust. Are you paying taxes? Trust paying taxes? The beneficiary? So your accountant, your attorney become very integral and important with the irrevocable trust structure.
Right. So there's a trade-off to establishing a trust. There's a cost to doing it, and those are some of the costs. So there's a type of trust that can be changed, the revocable during your lifetime, and a type that can't. That's the irrevocable. Jackie, besides estate tax planning, what are some reasons clients consider a trust?
I think there's many different reasons that you can consider a trust, but I would also say it's certainly not a necessity for all. Some reasons that you might consider it is if you desire privacy, because a trust is going to be a private document, whereas a will is public. And I know Pamela last week shared a story of how a neighbor was going to the court to read the wills of those who had passed away. What if you want to simplify the estate settlement process and potentially eliminate that need to go to probate for your family? Residency state's going to be a big consideration. There's certain states where the probate process might be a little bit more difficult. It could be costly and timely, and a trust can ease that process. If you're somebody who may have real estate in multiple states, your family might have to go through what's called ancillary probate, and that's going to be a secondary proceeding required in the non-resident state in addition to the primary residency state. And a trust can also eliminate this. What if you want to actually just put some guardrails or protection around the distribution? I have many clients where they want to have assets distributed at certain milestones for their family or at certain ages. And that's where a trust can really help. And there was a client that Pamela and I worked with, and she was actually concerned that her son, who's in his 20s, that if she passed away, she said he would immediately gift all the money to charity. So she chose to put some guardrails in place for a portion of the assets to try to protect his future lifestyle and ability to use these assets if he needed. And then I would also say that trust can also be used for asset protection for potential lawsuits or creditors of your beneficiaries, or if they were to potentially get divorced. And then another big reason is special needs planning. So if you leave assets outright to a beneficiary who has special needs and is receiving governmental assistance, receipt of those assets can disqualify them from receiving that governmental support. And that's where you would want to consider potentially setting up a special needs or supplemental needs trust, as that's going to provide for the individual's financial support without jeopardizing their access to the social services benefits. But I would just note that these are very highly specialized and they must conform to very specific requirements. So you do want to make sure you're working closely with somebody who is qualified, like an estate attorney, to help you with this. And then the last reason I'll note is let's not forget our pets. I have many clients where they want to ensure that if they don't outlive their beloved members of their family, they want to make sure that the care and maintenance of their pets would still be there. And that's where they can look at a pet trust that can help for this.
Yeah, we see this more and more. Let's face it, pets are part of the family, and so people want to make sure that they're cared for, as you mentioned. So with an irrevocable trust, generally speaking, the grantor permanently relinquishes control of the assets placed in the trust. I want to go into a couple of potential scenarios. Pamela, so let's say that you and your spouse are concerned about never having access to trust assets if they're unexpectedly needed in the future. How do we help those clients?
Yeah, well, let's not forget it's still an irrevocable trust, but high net worth married couples could consider something called a SLAT, a spousal lifetime access trust. It's a way to give assets away, and what it's trying to attempt is to potentially reduce estate taxes. So the donor spouse can set up a SLAT to benefit their descendants while also having the spouse as a beneficiary who could have limited access to the assets. So say a married couple has a combined net worth of 50 million. Without prior use of any of their life estate and gift tax exemption, one spouse could transfer, let's take the whole exclusion, transfer 15 million into a SLAT for the benefit of the other spouse and descendants. They would utilize their whole $15 million exemption. Of course, we're using 15, but it could be an amount less than that. Now, when the beneficiary spouse dies, the trust assets pass without estate tax to those remainder beneficiaries, right? So the hope is that 15 million grew to 20 million and we got 20 million out of the estate to the remainder beneficiaries. So there's several benefits to this approach. Ones that must be weighed and considered with an attorney. Some benefits could be removing the appreciation, as we just mentioned, flexibility, control, as well as offering the spouse that limited access to the fund if they did need it back or needed a distribution. But despite the flexibility the SLATs offer, right, we talked pros and cons of everything, clients should keep in mind that strategy is only effective when the assets transferred to the SLAT, again, are one that we talked about not anticipated being used by the couple and the standard of living. So I would say, Jackie, that's where you become very important, right? Work with the financial professional to really understand how much you can afford to put in a SLAT or any gifting.
Yeah, exactly. I mean, you don't want to give money away again that you can't afford to give away. And in this particular case, using your lifetime exemption only to bring the assets back into your estate is probably not the best solution. Okay, let's move on to another common estate planning goal, which is someone who wants to ultimately pass assets to the children from a previous marriage. How do we help them?
I mean, it's very, very common question, right? Our blended families, where do you want to leave assets? Maybe you want to leave assets to your spouse, but if your spouse passes, you want the assets to go to your side of the family, your children, your favorite charities, your nieces and nephews. In this instance, you could consider something called a QTIP, a qualified terminable interest property. A QTIP trust is designed to provide lifetime income to that surviving spouse while transferring the remainder interest of what's left to the beneficiaries that you choose. So it's a consideration that if the assets in the trust, you have to keep in mind that the assets in the trust are included in the surviving spouse's estate at death. So this is not really a estate tax planning technique, right? Generally speaking, but it's more about, I want to leave you assets. I want you to enjoy them. But when you pass away, my wishes come back to my estate. And sometimes it's about keeping the peace between the families.
Yeah, exactly. Okay, what if a client is looking to pass wealth to multiple generations?
Yeah, so families seeking to preserve wealth across generations, they often use irrevocable trusts. We call them irrevocable dynasty trusts, right? It's going to protect assets from the estate and generation skipping transfer tax, as well as potentially creditors. Dynasty trusts are they're designed to last for generations, right? That's that dynasty word, and take advantage of the abolition of what something was called the rule against perpetuities. However, in many states, the common law and statutory rule may still limit the amount, right? It may not be able to go on forever. So therefore, discussing in detail which state you set up the dynasty trust in is definitely a critical decision. Funding an irrevocable dynasty trust, it's going to require that the grantor of the trust, the person who makes it, gives up control of the assets, right? Again, irrevocable, give up control. They're being transferred to the trustee, the person who's going to manage the trust in accordance with the terms that you've laid out. And then once established, the trust generally, it can't be changed, right? There's some ways, but generally speaking, think of it as can't be changed. And doing so, it could create risks with the money being brought back into the estate for estate tax purposes. So with any irrevocable trust, there's no guarantee that a trust set up today will continue to work with what you intended decades from now. The laws keep changing. Your family circumstances are likely to change as well. And depending on the provisions of your trust documents, the trustee needs some flexibility. They may be unable to address those changes. So when working with your attorney to draft the trust, you definitely want your attorney to suggest to you some certain provisions that are designed to help preserve your intentions, but allow this trust to adapt to the changing times.
Right. So let's see, we have Cupid, Slats, Dynasty Trust. Jackie, let's give Pamela a little bit of a rest. We know many of our clients are also interested in philanthropy. Last week, you touched on split interest trusts. Help us understand what these trusts are and how they can help someone to both create a legacy and support the causes they care about, while also potentially reducing income and estate taxes.
Yeah, so David, I think with charitable giving and philanthropy, there's so many different ways to achieve this. But if we focus specifically on trusts, there's actually charitable trusts that can be established, and they can provide income to the beneficiaries while also supporting charities. One such trust is going to be a charitable remainder trust. And this is an irrevocable trust that's going to allow you to split a trust assets between both charitable and non-charitable beneficiaries. With this trust, you're going to generate an income stream for you or another beneficiary for a specific number of years, but no more than 20, or potentially for the life of one or more non-charitable beneficiaries. And then, as the name suggests, charitable remainder trust, those remaining assets are going to go to one or more charities. And this trust structure is going to allow donors to preserve the value of an asset placed into the trust, receive an upfront tax deduction, while also deferring taxes on any gains that are realized inside the trust. And now, another type is a charitable lead trust. And this is the inverse of a charitable remainder trust. So with a charitable lead trust, it's also an irrevocable trust that's going to generate a potential income stream for the named charitable beneficiary, with the remaining assets eventually going to the non-charitable beneficiary. These trusts are not tax exempt, and the tax treatment will depend on how you set it up. But in essence, what these charitable lead trusts will allow is for you to remove assets from your estate while reducing the amount of tax your estate will pay and preserve the funds for heirs. And there are variations of these trusts, which to use are really going to be dependent on many variables. But that's an area that your estate attorney, as well as your financial representative, can assist with to help you find the most efficient solution to really meet your income needs, as well as your charitable intentions.
Okay. A key part of setting up a trust structure is choosing a trustee. I know a lot of folks think that a trustee and an executor are the same thing. But Pamela, how is the trustee role different from the executor's role? And what are the considerations in selecting a trustee?
Absolutely. And I think the consideration point, a lot of times there's a knee-jerk reaction to choose somebody, but you really need to definitely think about who you're choosing. So the executor is responsible for managing the affairs of settling the estate. Maybe that's including initiating court proceedings, filing the deceased tax returns, and the executor is generally named in a will. A trustee acts as the legal owner of trust assets, and they're responsible for handling any of the assets that are held in the trust and the tax filings for this trust, and distributing the assets according to the terms of the trust, kind of like the gatekeeper of the trust. Generally speaking, a trustee's role is one that continues on much longer than an executor's, right? Once probate is done, generally speaking, the executor's job is done. Both the executor and the trustee roles involve duties that are legally required, right? And they have a legal responsibility to act in the best interest of the beneficiaries. However, trustees and executors are primarily responsible for the different parts of the estate. In general, executors carry out the terms of the wills, as we mentioned, trustee terms of the trust. And I often get the question, can the same person play this role? The answer is yes, the same person can. Sometimes we have clients that choose family members, they choose friends, right? We talked a lot about last week. Keep in mind the different factors when you're choosing an executor or a trustee. And if you're struggling with the decision, you could always consider a corporate trustee as well.
Right. And I know that clients can be unsure about how much to
Yeah.
share with their heirs, about their estate plan. Jackie, how do you help clients address this?
So, David, I don't know if you recall, but last week I had mentioned how transparency can be a very difficult topic and how much one chooses to share and when is really a personal decision. But when working with my clients, we want to think through these decisions and the impact or potential unintended consequences of not involving the family. And Fidelity had actually completed a study last year that highlighted a powerful yet often overlooked opportunity for families to try to strengthen connections. And what it showed is that 97% of families recognize the importance of having conversations about estate planning, yet half haven't even engaged in these critical conversations. A similar percentage haven't shared any details on what their loved ones will inherit, if anything at all. So this really unveiled that there's a disconnect between the next generation who feels ready to step up, but the parents or older generation disagree. And this can lead to stress and ambiguity, potentially even the mismanagement of the estate or misalignment in how your wishes and objectives are carried out. And I think it's important to also remember that transparency does not mean that you have to divulge every detail or the actual financial numbers, as that's a personal decision and something that you may choose to share more about over time. And if you're thinking about how to start, my advice is start simply. Discuss personal values and then build momentum to discuss eventually financial and healthcare wishes or fears. And try to involve your family in the process to hear their perspective. And again, this doesn't mean their perspective or feedback is going to override your own. But if they're going to be impacted by your decisions, they should have some level of clarity so that they can properly plan for their needs now and in the future. So when I'm working with my clients, I found that these conversations can truly help you and your family to become closer and better aligned to provide everyone with some sort of peace of mind.
Great advice. Pamela, as someone who has worked in this area for many years, what are a couple of the biggest pitfalls or mistakes that you see clients make?
Yeah, so lots of things go wrong within estates. I think sometimes it stems from you do the hard work, you see the attorney, you get your documents signed, and you just want to be done, right? Take a deep breath and be finished. But we just talked about one naming the wrong executor or trustee. We actually see that a lot in some of these celebrity deaths that we're seeing now. Also, your beneficiaries, you're leaving it to somebody, but there's sometimes an unfortunate case where the beneficiary is either aged or has passed away or is sick. So you need to think about always updating for beneficiaries. A popular one is you move, right? You live in a different state, you have to have your documents updated and looked at in that new state. How many times, David, have we heard, I have a trust, but I never funded it? That's a very popular one. Jackie, if I had a recording of that one, right? But yeah, if you're out there and you're listening and you have any type of trust that you've set up, definitely revisit it and think about what you funded it with, or if you haven't funded it. Another big one is the beneficiaries and your documents don't match, right? You want to make sure that they're coordinated. We talked a lot about this last week, that beneficiaries override what you've done in your will. Thinking about taxes, you got to balance. Hopefully today you see that we're talking about balancing income tax, estate taxes, and managing the two. Jack, you just mentioned the family conversation. That's a big one. And I would honestly say the biggest problems and issues that I see is inaction, and that's doing nothing, right? You want to have something down in writing and control your legacy.
Yeah, you saved the best for last. Those are all great hints, but that inaction one is so important. All right, thank you both very much. This has been another super informative session. For me, here are some key takeaways and next steps. One, tax treatment matters. Not all assets are taxed the same when inherited. Review your accounts and the beneficiaries with your financial professional to understand potential tax outcomes for heirs. Number two, trusts can help with more than tax concerns. They can provide control, privacy, protection, and solutions for complex family or legacy goals. Discuss trust options with your estate planning attorney. And three, revisit and communicate your plan regularly. Estate planning isn't static. Changes in laws, family dynamics, or goals can require updates, and clear communication with loved ones helps avoid confusion and conflict. We hope you'll join us next week at our Ask Fidelity Anything session. That's on Wednesday, April 22nd. It's the finale of our three-part series. We'll be focusing on your questions on any aspect of estate planning. In the meantime, reach out to your Fidelity representative to discuss how your estate plan fits into your financial plan. And remember to consult your tax and legal advisors about your own situation. For more timely market updates and insights on other financial planning topics, subscribe to Insights from Fidelity Wealth Management for exclusive invitations to future wealth management webinars and access to our weekly newsletter. Thanks again for joining us. Have a great day.